This is your tech news briefing for Tuesday, November 15th. I'm Zoe Thomas for the Wall Street Journal. After years of arguing against regulation, a lot of people in the crypto industry lately have been pushing for oversight, with a lighter touch. But the crisis at FTX has put plans for some new crypto legislation on hold. According to WSJ sources, the Senate Agriculture Committee, which oversees the federal agency that could be tasked with regulating crypto, has scrapped a tentative plan to mark up its bipartisan crypto bill this week, a bill that had been drafted with FTX's input. At the same time, regulators are expected to increase their oversight and investigations of crypto firms, hoping to give investors in the space a little more security. Joining us to discuss what this means for the sector is our reporter in Washington, Paul Kiernan. Hi, Paul.
Hi, Zoe.
Paul, can you start by telling us a bit about what was the point of the crypto legislation that the Senate Agriculture Committee was looking at? I mean, what was in it and why were they considering it?
So at a high level, the Senate Agriculture Committee bill, it's called the Digital Commodities Consumer Protection Act, or the DCCPA. What it would have done is it would have given the Commodity Futures Trading Commission jurisdiction over Bitcoin and Ether and probably a few other cryptocurrencies. The CFTC, as that regulator is known, is the smaller of the two market regulators. The bigger one is the Securities and Exchange Commission. And it does not have any rules in place currently that it could really use to regulate these markets. And so one thing we know is that if this bill were passed, it would mean several years of rule writing efforts by the Commodity Futures Trading Commission to build this regulatory framework for crypto. And of course, during that time, the crypto industry would be heavily lobbying the CFTC and Congress.
And what would the bill have meant for other crypto tokens besides Bitcoin and Ether?
There were various versions and drafts of this bill circulating, but it would have preserved the ability for the Securities and Exchange Commission to say, wait, no, that looks like a security that's in our jurisdiction, and go after crypto exchanges for listing crypto tokens that met the definition of a security. Now, one reason the SEC didn't like the DCCPA is that it would have deferred to the crypto exchanges in a first instance for determining what type of asset a given crypto token was.
So this would have given crypto exchanges like FTX and others the power to decide whether or not something was a security or a commodity, something that usually regulators get to do.
Yeah, right. I mean, theoretically, it wouldn't have given the crypto exchanges the final say. The SEC could still come in and second guess their decision, but it would have deferred to a certain degree this distinction to the crypto industry. Again, there were various versions of it that were circulating and tweaks being made. And so, a final version of the bill is not in existence because they haven't voted on it.
There is an expectation that regulators like the SEC will step up their oversight of the industry, particularly given what's happened at FTX. How do we expect that to play out?
For the past year, the crypto industry in Washington has gotten a lot more organized with lobbyists and spending. And the result of that has been more and more lawmakers, Republicans like Tom Emmer, Democrats like Richie Torres, many more, repeating crypto lobbyist talking points, one of which is the SEC should not do regulation by enforcement. Rather than enforcing the existing laws, the SEC should provide more regulatory clarity to the crypto industry to tell crypto companies exactly what they can do, not just what they can't do. The SEC has maintained for several years now that the laws are clear, that there is a really pretty straightforward test called the Howey test that determines when something is a security and when it's not. And the crypto industry is just trying to kick the can down the road. One upshot of the FTX implosion is that it's going to push the needle towards enforcement.
Let's take a moment to talk about the investigations into FTX. Who is looking into them right now, and what are they looking to find?
Yeah, so the SEC is investigating FTX. They were frankly investigating FTX before this happened, but the investigation has widened in the wake of the collapse. They are looking into whether FTX listed unregistered securities, whether its lending product constituted an unregistered security. More recently, they've been looking at the interconnectedness, the links between FTX.com, which is the global exchange, FTX.US, which is its US subsidiary, and Sam Bankman-Fried's trading firm Alameda Research. We've reported that FTX, the exchange, lent customer funds to Alameda Research, which is generally forbidden.
What other crypto-related investigations have we seen the SEC and, other agencies carrying out, and what do we expect the impact of those to be?
It's hard to say at this point. We've reported that the SEC was investigating Binance. Coinbase, which is a publicly traded company, as well as a crypto exchange, has disclosed that it was under SEC investigation for various lines of business. SEC Chair Gary Gensler wants the crypto exchanges to register as national securities exchanges. There's a number of reasons why they don't want to do that and why that would be difficult, but he has expressed a willingness to work with these companies to try to get them registered. There's some risk if the SEC were to file a lawsuit against a crypto exchange, particularly one whose finances aren't audited and publicly disclosed. There's some risk that it could precipitate a collapse, or that it would, a cease and desist order might cause the exchange's customers to lose access to their money. And so I think that from the SEC's perspective, the best thing would just be to register all these companies and get them to comply with the law. But Gary Gensler has said if they don't do that, if they don't make any headway, and there's nothing public that has come out that suggests there's a lot of headway being made, the SEC will bring enforcement cases. It'll sue them.
All right, that's our reporter, Paul Kiernan. Thanks for joining us, Paul.
Thanks for having me.
And that's it for today's Tech News Briefing. If you want more tech stories, head over to our website, WSJ.com. I'm Zoe Thomas for the Wall Street Journal. Thanks so much for listening.